Hello and welcome back to Chart Pattern Trading Masterclass by Wealthy Education. In this video, we'll talk about mastering support and resistance. So, support and resistance, you'd be hard pressed. It's not completely impossible, but you'd be hard pressed to find a technical analysis system that doesn't take support and resistance into account. Support and resistance is by far probably the most widely followed thing on charts. So it makes sense that you pay close attention to it because if you do not, you run risk of ruin. Support is where the market supports price. Resistance is where the market resists price. So pretty straightforward, really. Notice as I mark on the chart, some of these levels. We'll talk about support first. Notice how the market did not want to break down below that area and it bounced from there. Notice how you could say the same thing about this area at least twice. This happens to be Tesla, but this works the same on any other um, asset. So let's take a look here at the idea of resistance. Now, resistance is where the market is resisting price going over. You can see that we tried to get up here and we ended up failing twice. That is the market resisting breaking above there. There is a slight difference between a swing high and resistance. Resistance is an area that has proved itself. Like a swing high is just an area where we swung up to and then we broke down. Just like this potential swing low here. Is it support? I mean, it could be, but it turns out that it isn't because notice that the market just kind of slipped through it. So that's your basic um, explanation of support and resistance. And the thing that makes support and resistance so important is that it gives you a heads up as to where you may see buyers or sellers come in. Doesn't mean they have to, it's just where they have in the past. What causes support or resistance to form is typically money flowing into the market. So, for example, this resistance area here, there were people willing to dump their stock, in this case, again, Tesla, or even short it in this, say, $310 range. So that forms resistance. There were buyers and they sold to them, and then there were buyers and they sold to them. And then the sellers got more aggressive, finding buyers at lower prices, and then they continue to push things lower. The same thing can be said if you're buying. There are value hunters down here that want to jump into the market, and they did 3 or 4 times on the way back up. And that's how you have to look at it. You have to look at it. It isn't quite right to say there's more buyers than sellers. It kind of is. It just means that, like in the case here, the sellers were more aggressive. So when price started dropping, they were willing to sell, keep selling, and there were people willing to buy, but they were much more aggressive about it. They were reaching down, if you will, to meet those buyers. So how do you draw the lines? Well, it's really quite easy. There's a trend line tool over here, a little menu. You click on this arrow and you go to horizontal line and you just click it on the chart. Notice there's a bubble. You just hold your mouse down and drag it back and forth. So this is our resistance area. You mark that with a line, for example. That's our support area and resistance. And that brings up the next point. Support and resistance tends to have what is known as market memory. So what I mean by that is notice how this was support, that was resistance, this was resistance, this was resistance. This was support, but it was resistance here, and it was support there, and it was resistance in this area. It was support there. So the best way I know how to describe this is through the prism of a real world example. So let's say you have a building, and let's just say there's three stories, three poorly drawn stories. So, why would there be support and resistance market memory? Well, if you're on um, floor one and you're a buyer, this is your resistance, it's your ceiling. There are sellers there. Well, what happens if you jump up to floor two? Floor two now sees that as the floor, that same level. Why? Well, it's the floor because think about it this way. If you were selling here or you were betting on the price going lower, if it comes back and you're break even after losing a bunch of money and you can get out relatively unscathed, you're more than willing to buy your short position back. Just like if you were up here and you break down, that becomes the ceiling. Why does it become the ceiling? Same reason. If you were a buyer up here at this point and price went up and then fell back down, if it comes back here, you're more than willing to sell your position to get out of the market. Another thing that causes this is that people understand that the markets have made a move. So in this scenario, if you see the market break from the first floor to the second floor, or let's just say 125 was major resistance, you see it break above there, but it pulls back to this area. Not only are those people that were betting against the market, betting the price was going down, willing to get out, thus buying the position, buying back their shorts, you may look at that and say, hey, I want to get involved. And it's come back to the original breakout point. So those who missed everything here will jump back in. So that's part of the psychology. There are different ways to address how to identify major support and resistance levels. One of the easiest ways that I know, like take for example here, this is one, this is parity. This is an area where we've seen buyers and sellers in the euro. Let's go ahead and put in a couple of round figures, big numbers, 110. Let's see if that has any effect. You can see that buyers and sellers have been there. This is the daily chart. Let's go to the weekly chart. You can see that the market has flipped back and forth at this area. Is 110 a major area? I'd postulate kind of. Let's take a look at 105. 105, I think, is even more important. You can see that we bounced from there three times, kind of consolidated there, and then broke down. Let's do 120. You can see 120 has been important multiple times. Now, I will also point out it has gone over there. Like in this area here, it got all the way up to like 123. Well, that comes down to that false breakout scenario. Plus, you have to understand that it's an area where something can happen. It's not something that has to automatically happen. So like in Ethereum, we go back down to the daily chart, 2000, probably an area that a lot of people would be looking at. And you can see it has offered support and resistance, but we slice through it a little bit. You can't just go, hey, it's right on the money at 2000. I should short or I should buy. That's where you look for the patterns. So the idea is you're building a foundation. And it doesn't have to be these round numbers, but it just seems like they repeat time and time again. So for example, 1330, you can make an argument that somewhere around 1375 makes more sense for support and resistance there. You can see where it's offered both. But the idea is you are trying to find these areas where the markets react to. And then look for a pattern, look for some type of confirmation and take your trade. it gives you an idea of where things could happen. Furthermore, let's go ahead and go back to our Ethereum example. Another thing that it can do, so let's just say you're looking for a signal there, and I happen to see one, kinda, and I definitely see one there. So you're looking for various areas that could be targets. If you got in over here, you'd recognize this is an area that could be a target, and you can see that's exactly where it went. It did go lower, granted, but it spent a long time going sideways there. So not only does it give you an indication of where you might want to get involved, it can give you an indication as to where you're going. So in the next video, we'll talk about trend lines and moving averages, two very commonly used tools in a trading system.